Okay, so hi everyone. I just want to run through something really quickly today, which is about depreciation. So the way I think about depreciation is effectively, I think about it as cash, in terms of cash coming into a property. So if you think about a lot of other expenses that are attached to property, pretty much most of those you have to pay something out of your own pocket, whether it's insurance, property management fees, your interest on your loans, etc. So that's all dollars coming out of your pocket. Sure, you can claim a deduction on that, but ultimately that's cash you have to pay out. The difference with depreciation, it's what they call a non-cash item. So you don't physically transfer any money out of your account to pay for depreciation. Depreciation is basically a deduction that you get on your tax return. So it's basically what they call a non-cash deduction. The benefit of that, because you're not actually physically paying anything out, that non-cash deduction allows you to write down your taxable income, which therefore can actually bump up your tax refund associated with that property. And if you think of a tax refund, that's money coming back into that property rather than money going out. So look, just briefly, there's two types of depreciation attached to a property. The first one is plant and equipment, and the other one is capital. So plant and equipment, if you think about it, if you're looking at a property, that's effectively everything that's not bolted down, if you like, that's replaceable over time. So that would be like air conditioning units, screens, blinds, floor coverings like carpet, etc. Those items over time ultimately will get wear and tear and ultimately need to be replaced. So those items are treated differently to capital. So those items generally will expect to have a shorter lifespan, so therefore they'll be written off basically a lot sooner. And the tax office sets different scales on what those items could be written off at. The other one then is capital, which is effectively everything that is bolted down, if you like. So that's basically your four walls and your roof, all the physical structure. So obviously that's expected to have a much longer lifespan, and therefore the write-off on that is over a much longer period of time. So in terms of how are those items written off? If you look at capital, so the build cost on that property or historical build cost, effectively it's based on 2.5% of that historical build cost over the life of that property. So capital effectively ends up being a straight line depreciation, if you like. It's just written over the life of that property. Plant and equipment, on the other hand, like we said, because it'll generally have a shorter time frame, a lot of the write-off on that is at the initial stage of the property's life. So generally at around about the first sort of 5 to 6 years is where you find a big chunk of that depreciation on that property. Once you sort of get past 5 years and start to stretch out to 10, it drops off fairly considerably. So, roughly how would that be split on an average property? You tend to find around about 5,000 would be sort of an average for a build in terms of how much you could write off a year. And then the initial stages for your plant and equipment around about 5,000 as well, and then tracking down over time. Now here's one of the main things of why this starts to become important is that a couple of years back the government actually changed the policies around depreciation and put a distinct difference between how that would be treated for new properties and how that would be treated for established properties. So for established properties, effectively now that plant and equipment is wiped out. So the only thing they can claim is the historical build cost. The only way they can claim any plant and equipment is only for any new expenditure. So whatever plant and equipment is in that property when you buy it and it's an established property, none of that is claimable. The difference when you do a brand new property is all the plant and equipment is claimable, and of course all the build. So the difference here is buying an established property. If you're looking at two properties, one was new and one was established, you could be potentially missing out on $5,000 or so worth of tax deductions attached to that property. And if you think about depreciation in terms of cash, that means you could be missing out on thousands of dollars worth of cash each year. Anyway, so that's just a very brief overview of depreciation. Coming up in future videos, I'll try and cover a little bit more and a few more things to think about. Thanks very much.